Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 1, and specifically I want us we look on the subtopic of deferred tax. So this, first of all, is an extension of what you covered in financial reporting and analysis, intermediate level, where you did something to do with the accounting for current taxes and also accounting for deferred tax. So at the advanced level, you need only to cover the concept of deferred tax, but at the advanced level, also the examiner will test the concept of group account. For example, you need to know how to compute things like the unreleased profit and so on, because the examiner may give you some goods which were maybe sold by the parent company to the subsidiary, and you're told some of the goods were not yet sold at the end of the year. So basically, you have to be able to determine the cost of those particular goods. And for you to do that, you must be in a position to determine the unreleased profit. So therefore, at this level, you just need to cover the concept of deferred tax, but now with a group with a group aspect. Now, I want us to look on some few illustration questions, but before you do that, I want us to look on a quick recap of basically what you need to know as far as the deferred tax is concerned, so that we can be able, we can be on the same page. So first of all, a deferred tax, basically we say this is a provision created by the company during the current financial year for a tax which is supposed to be paid by the company in the future, or a tax which is supposed to be recovered by the company in the future. So equally, when computing for the deferred tax or determining the amount of deferred tax which is to be provided for in the income statement, we have two approaches which may be used by an entity. Number one, we have the income statement approach, whereby the deferred tax to be charged in the income statement, to be taken into account in the income statement, is computed using something called the timing difference. The timing difference is the difference between the accounting profit and taxable profit, and which give rise to deferred tax. But now, International Accounting Standard number 12 do not do not prefer entities to use that particular method, and therefore the other method which is recommended by IS 12 is the balance sheet method, whereby the deferred tax is computed based on something called the temporary difference, based on something known as the temporary difference. So what is a temporary difference? A temporary difference basically is the difference between carrying amount and the tax base of the asset and liability. So which in this case we have two types of deferred temporary difference. We have the taxable temporary difference and also the deductible temporary difference. Maybe we can just start our recap there. We say that deferred tax, this one, according to the balance sheet, maybe you can just say according to a balance sheet or statement of financial position approach, and which you have said is a method which is recommended by International Accounting Standard number 12. According to balance sheet or statement of financial position approach, deferred tax is computed using temporary difference. Difference, which is abbreviated as TD. And what is a temporary difference? A temporary difference, this is the difference between the tax base and the carrying amount of asset and liabilities. So temporary difference, which is abbreviated as TD, is the difference between the carrying amount, which is abbreviated by CA, and the tax base. So when talk about the carrying amount, we have to recall what you covered in the lower level. Carrying amount is the value at which an asset or even a liability is recorded in the company's statement of financial position. For example, when talk about the carrying amount of PP, we are talking of the net book value. So on the other hand, when talk about the tax base of asset and liabilities, this is the value of an asset or liability for tax purpose. For instance, equally when talk about the tax base of the PP, we are talking of the written down value. Written down value, which is computed by taking the cost of the PP minus the total capital allowance, or minus the total wear and tear what allowance. So that is the first thing you need to recall, that what is carrying amount and also what is tax base. Now in this case, this temporary difference can either be taxable temporary difference, or deductible temporary difference. Taxable temporary difference, abbreviated as TTD. Deductible temporary difference, abbreviated as DTD. So a temporary difference is taxable whereby the carrying amount of asset or liabilities exceed the tax base. But on the other hand, if the carrying amount of an asset or liability is less than the tax base, then you get something called a deductible temporary difference. A deductible temporary difference. Now, a taxable temporary difference, this one gives rise to something called a deferred tax liability. Deferred tax liability, abbreviated as DTL. And therefore, to compute the deferred tax liability, we take the taxable temporary difference times the tax rate. Times the tax rate, abbreviated by TR. So this taxable temporary difference times what? Times the tax rate. But on the other hand, a deductible temporary difference, this one gives rise to something called the deferred tax asset. A deferred tax asset is a tax which is recoverable by the company in the future. Deductible temporary or deferred tax liability is a tax payable by the company in what? In the future. So how do we therefore compute these a deferred tax asset? To compute the deferred tax asset, we take the deductible temporary difference, DTD, equally times what? Times the tax rate. Times what? The tax rate. So therefore, this is the first thing you need to recall from basically what you covered in financial reporting and analysis intermediate level. And I think with that particular small recap, we can be able to proceed and look on a question from a past paper. And basically this is a question which was tested in the sitting of August 2022, and specifically it is question number 2B. So we go through the question, we see what we are told, and it reads: T Limited, a public limited entity, is a holding company in a group of companies. The following transactions related to deferred tax or the foreign transactions relating to deferred tax were extracted from, for the purpose of finalizing a group financial statement for the year ended 30th April 2022. Number one, you're told T Limited own property, plant and equipment that cost shilling 625 million when purchased. Depreciation of shillings 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant and equipment of shillings 300 million. And then you're told on 30th April 2022, the property, plant and equipment was revalued at shillings 575 million. Number two, we are told on 31st of October 2021, the company completed a development project and incurred a cost of 200 million, which it capitalized in accordance with IS 38. The estimated economic useful life of the intangible asset was 5 years at 31st of October 2021. Then you're told the company obtains a full tax relief for research and development expenditure on cash paid basis. Number three, we are told during the year which ended 30th April 2022, T Limited transferred goods worth shillings 1,500 million to one of its subsidiaries. T Limited made a gross profit margin of 20% on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date of 30th April 2022. And then number four, we are told the trade receivables were carried in the consolidated statement of financial position at shilling 480 million. This was after allowance for doubtful debts of shilling 60 million and unrealized foreign exchange gain of shillings 80 million. The allowance for doubtful debt and the foreign exchange gain stroke losses are only allowed for tax purpose when realized. And then you're told number five, the balance on the deferred tax liability account of T Limited as at 1st May of 2021 was shillings 25 million. And then number six, we are told the income tax rate applicable to T Limited for the year which ended 30th of April 2022 was 30%. So what are we required to do? Roman 1, compute the relevant temporary difference as at 30th April 2022, and Roman 2, we are required to prepare a deferred tax account. So basically, this is a question for deferred tax, but as you can see from the information which is provided here, this is information relating to a group of companies. That's why we are saying at this level, the questions which will be tested for deferred tax, they do have the aspect of the group. The aspect of what? Of the group. So let's start with Roman 1 of that particular question, whereby the examiner was requiring the candidate to compute the relevant temporary differences. So how do we prepare these temporary differences? We need to prepare something called a SEO of temporary differences, a SEO of TD, temporary differences. So in this SEO, we need to have a number of columns. So the first column here will be for the various items of asset and liabilities which are provided. And then the next column here will be for something called the carrying amount. Carrying amount abbreviated as CA. We have another column here for tax base. Tax base, and the last column here for the difference between the tax base and the carrying amount, which is the temporary difference. Also, if you check on the figures which are we are given in that particular question, those figures are in million of shillings. So we need to indicate that our figures here will be in million of shillings. In million of shillings, like that. Yes, so what we need to do, let's start with the information which is given in note 1. And in note number 1, we are given information about PP. So therefore, what we do, we first of all record that item here. We are given the item of PP, property, plant, and equipment. And you're told that the cost of this property, plant, and equipment was 625 million when it was purchased by the company. And then you're told it has been depreciated, or the depreciation which was charged as at 30th April of 2022 was 250 million. In other terms, this is the accumulated depreciation as at that date. And then you're told the entity has claimed a total capital allowance on property, plant, and equipment of 300 million. And then you're told at the end of the current year, this particular property, plant, and equipment were revalued at an amount of how much? 575. Now, as far as the PP is concerned, we are given three values there, or basically we can be able to determine three values. Number one, we can be able to determine the net book value of this PP, which will be equal to the cost minus accumulated depreciation. So the costs of this particular property, plant, and equipment is 625 million, and you're given the accumulated depreciation of 250 million. So we need to get the net book value. Remember, the net book value is the same with the carrying amount, or basically, yes, this will be the same with the carrying amount. And then also we are given the revalued amount. We are told these items of PP were revalued at the end of the current year at an amount of 575 million. And also from the information which you are given in that question, we can be able to get something, or to compute something called the written down value. The written down value, this one is equal to the cost minus the total capital allowances. Capital allowances which have been claimed by the company. So we know the cost is 625 million, and then the total capital allowances claimed by this company is 300 million. So this will give us 325 million. So this 325 million, maybe to start with that, that is what if far as the carrying, not the carrying rather, this is the tax base. This is the tax what? The tax base. So the value of an asset, or basically those particular assets which qualify for capital allowance, their value for tax purpose is always equal to the written down value, which is equal to the cost minus the capital what? Allowances. So therefore 325, that is basically the tax base. tax base. Remember, the tax base is the value of an asset or liability for tax what? Purpose. So therefore, the value of these items of PP for tax purpose is written down value. What about the carrying amount? Now, for carrying amount, here we have two values. We have the net book value and the revalued amount. Now, a question arises here. Whenever the company has revalued the asset at the end of the year, those particular assets in the statement of financial position, are they supposed to be recorded there at net book value? Are they supposed to be recorded there at the revalued amount? So automatically, anytime the company revalue the asset, those assets are recorded in the statement of financial position at the revalued amount, not at the net book what? Value. So therefore, the carrying amount, which is the value at which these particular items of PP will be recorded in the statement of financial position, is what? 525. So, and then what we need to do is basically to get the difference there. The difference or the temporary difference, this is equal to this minus that, which will give us 250. And because it's a positive figure, we refer to that as taxable temporary difference. If you get a negative figure, it is a deductible temporary difference. But it's also important to note that from the information which are given here, you can see these items of PP were revalued to 575. But in this case, we have the carrying amount, or basically the net book value, I think, which we needed to compute here. So this will give us 375. So that was the net book value of these items, but they were revalued to an amount of how much? 575. Automatically, what that means is that there was a revaluation gain equal to the revalued amount, 575 million, minus the net book value, 375, and basically this should give us 200 million. So 200 million, this is a revaluation gain. And according to IAS 12, anytime the company revalue items of PP, and that give rise to a revaluation gain, then the entity should do what? Determine something called the deferred tax expense. So how is this deferred tax expense accounted for? We take the revaluation gain times the tax rate. So the revaluation gain in our case is 200 million. And then the tax rate, as per, we are given the tax rate in the additional information number 6, 30%. So this will give us 60 million. So how is this deferred tax accounted for? The deferred tax expense accounted for. This deferred tax is accounted for by debiting the account called the revaluation reserve account, and then we credit an account called the deferred tax account. So when answering, or basically when preparing the deferred tax account as required in Roman 2 of that question, that is the moment you're going to take into account that particular word, deferred tax expense. That deferred tax expense will be credited in that account. But what we need here is the carrying amount and also the tax base. So let's move to point number 2 here. And in point number 2, we are given information about the development project which was undertaken by this company, where we are told the company incurred a cost of 200 million and capitalized that cost in accordance with IS 38. So anytime the company is, for example, developing a certain product and so on, and the company has incurred some development cost, that development cost should be capitalized. In other terms, it should be treated as an asset. Now, in this case, what we need to do is to determine the carrying amount and also the tax base. Now, the carrying amount, or basically the amount at which this particular development cost will be recorded in the company statement of financial position, is always equal to the cost. So the carrying amount of this development cost is equal to the cost. This is the carrying amount is equal to the cost minus the accumulated amortization. Amortization. Amortization is the amount which has been written off. So we know the cost is 200 million. And then in this case, we are told that this particular development project was completed on 31st of October 2021, meaning that this 200 million, it was capitalized from that date. Or in other terms, it was treated as an asset from 31st of October 2021. 2022. But in our case, we also know that the current year is ending on 30th of April 2022. We are told this cost was capitalized from 31st of October 2021. So how many months do we have here? So we have November, December, January, February, March, April. 1, 2, 3, 4, 5, 6. So mean that we have 6 months. Or basically this development cost was capitalized 6 months now to the end of the year. And the reason why that is important is because the amortization we are going to deduct from this particular cost will not be for the whole year, but rather it will only be for 6 months. So therefore, what we do to compute the amortization, we take the cost, which was capitalized 200 million, we divide that with the estimated useful life of this asset, which are 5 years, and then this will give us amortization for the whole year, but in our case, we are only interested with amortization for just 6 months. So this will give us 40, and then half of that is 20. So this will give us 180M. 180M is the carrying amount. What about the tax base? Tax base, in this case, is equal to the amount which will be allowed for tax purpose in the future. There is some information which you are told in this question that the company incurred this particular development cost during the current year, or basically before the end of the year, 6 months to the end of the year. And then in the last sentence, we are told the company obtained a full tax relief of research and development expenditure on cash paid basis, meaning that anytime the company has incurred development cost or even the research cost, that amount will be treated as an allowable expense once it has been paid. Once it has been what? Paid. So mean that this development cost has already been paid. Then the tax base, in this case we are saying, will be the amount which will be treated as an allowable expense in the future. And take into account the full amount has already been treated as an allowable expense. So the amount which will be treated as an allowable expense in the future will be what? 0. So therefore that is the tax base. So we get the difference here, which is 180, still a positive, and that is a taxable temporary difference. So let's move to point number 3. Where we are given some information. We are told during the year which ended 30th of April 2022, T Limited transferred some goods worth 1,500 million to one of its subsidiary, and then you're told T Limited made a gross profit margin of 20% on its what? Sales, and then you're told a third of these goods remained unsold by the subsidiary at the reporting date. Now, from that particular point, what our interest is the inventory. Basically, what we know is that, or what you're told is that the parent company, which is T, sold some goods now to the subsidiary, and basically some of those particular goods had not been sold to third parties. So meaning that some of the goods remained in the inventory or were part of the closing inventory of the subsidiary. That is our interest here. How much goods were not yet sold by the subsidiary at the end of the year? And in this case, we can be able to determine their value because here we are told the goods which were transferred by the parent to the subsidiary, they had a value of 1,500 million. But now the goods not yet sold at the end of the year, we are told they were a third. A third of that is what? Is 500 million. So this particular 500 million is basically the cost to this company. Is the cost to this what? To this company. But now what we know is that this particular goods have an element of unrealized profit. Have an element of unrealized what? Profit. So what we need to do is basically we take 500 million, we less the unrealized profit. How do we less the unrealized profit? The unrealized profit, this one is computed by taking the unsold goods. The unsold goods 500 million, 500 million times the gross profit margin. That is how we compute the unrealized profit from what you have covered in the topic of group accounts. So what we do, we take 500 million minus the unrealized profit, which will be equal to unsold goods 500 million times the gross profit margin. The gross profit margin in our case we are told is 20%. So this will give us 100. So 100 million. So therefore, this will give us for what? This will give us for 400 million. 400 what? Million. So this particular 400 million is basically the cost. is the cost. And basically what we know is that anytime a company is preparing, or even a group of companies preparing the consolidated statement of financial position, the inventory should be recorded there, mostly at the level of the net realizable value and the cost. So we know the selling price is 500 million, but the cost is what? Is 400 million. So therefore, this particular goods here will be recorded in the statement of financial position at what? At that particular amount which you have computed there. So therefore, in our case, we have the tax base, which is now 500 million. But we have said in the statement of financial position, this particular inventory will be stated there at what? At the cost, which is 400 million. And basically, we get the difference, this minus this, which will give us 100 million. And because it's a negative, that is a deductible temporary difference. Deductible temporary difference. So we are through with point number 3. Let's move to point number 4, where we have information about the trade receivables. The trade receivables. So for the trade receivables, we are already given the carrying amount. The amount at which the receivables are carried is the statement of financial position. No problem with that, which is 480. But we are told this figure was arrived at by this group of companies after making allowance for doubtful debt of 60 million and including unrealized foreign exchange gain of what? Of 80 million. Now, for you to be able to know how to determine the tax base of the trade receivables is always equal to the gross amount, because now what you're given here for 80 is the net amount. So this net amount of 480 is arrived at by the company after having deducted a provision for doubtful debt of 60 million, and also after including 80 million, which is unrealized, unrealized foreign exchange gain, unrealized forex what? Forex gain. So this unrealized forex gain is like an accrued income. It has been added in arriving at the figure of 480. So how do we get the gross amount? Because we are saying this is a net. Whatever you have here is a net. And we are saying that the tax base of receivables is always equal to the gross amount. So the gross amount in this case will be equal to 480. And then we add what has been deducted, 60, and then we less 80, which has been what? Added there. So that is how we arrive at the gross amount, which we are saying is what? Is the tax base. So this is like 480, and then we deduct 20, which will give us 460. So 460 in our case is what? Is the tax base. Yes. So I think we are done with that point. And then in point number 5, we are given the deferred tax liability at the start of the year, which we are going to use in Roman 2, and also in part 6, number 6, we are given the tax rate. So tax rate, basically, we are going to use it here. So therefore, what we need to do, we get the difference, this minus this, which will give us 20, a positive, and is a positive, so mean that is a taxable temporary difference. So take into account we don't have anything else or any other item of asset or liability which you are provided with. So what we need to do is basically to get the net amount here. So we add all that. We see what it will give us. So we have what? We have 250 plus 180 will give us 350, which is a positive figure, and we refer to this as net taxable temporary difference. Net taxable temporary difference. So that is it, that what was required in part A of that particular question. And basically by doing that, the marks allocated there were 6. And generally what is marked in such a question are these figures here. These are the figures which are marked. Basically by doing that, a candidate was supposed to get 6 marks. So let's move to Roman 2 of the question. And in Roman 2, we are required to prepare the deferred tax account. Deferred tax account. deferred tax account. So this one is basically quite simple because what we first of all record here is the deferred tax asset or deferred tax liability at the start of the year. And if we go back to the information we have in note number 5, we are told the balance on the deferred tax liability account of this group at the start of the year was 25 million. So I hope you can see we are told that is a deferred tax liability. So, and because it's a deferred tax liability, we record it as the opening balance in this account. On which side? On the credit side, because we know all liabilities have an opening credit balance. So the balance brought down is 125 million. There is also something else we also need to remember here. Okay, before we record this item here, remember there is an item which we said will be recorded in this account here, this one. So before we record that item, so first of all, we need to determine the amount of deferred tax at the end of the year. And take into account at the end of the year, there was a net taxable temporary difference. You have to recall what we said here, that a taxable temporary difference give rise to something called a deferred tax liability. So what we need to do is to compute the amount of deferred tax liability at the end of the year, which is computed by taking the taxable temporary difference, which is 350 million. We multiply that with what? With the tax rate. Tax rate we know is 30%. So this will give us now the deferred tax liability at the end of the year. So we have 350 times 30%, and that will give us 105 million. So this is the deferred tax liability at the end of the year. And such deferred tax liability at the end of the year, we record it on the debit side of this account, but down here. So the deferred tax liability at the end of the year is 105 million. So the other item which we need to record is what we have here, the deferred tax expense on revaluation gain, which we said in the deferred tax account will be that will be what? Credited. So we have the deferred tax expense, on a revaluation gain, which is computed as a figure of 60 million. And then from there, what we need to do is we balance our account. Of which now the balancing figure in this account is the amount now which will be taken to the income statement. Is either deferred tax income or a deferred tax expense. I think what we have on the debit side is more 105 million. So mean that we are going to have a balancing figure on which side? On the credit side, which will be equal to 25 plus 60, basically 85. We deduct that from 105, which will give us 20 million, and this will be taken to income statement, of which a balancing figure on this side, this one is known as a deferred tax expense. But if the balancing figure was on this side, still we take it to the income statement and we refer to that as deferred tax income. We refer to any balancing figure on this side as a deferred tax income, deferred tax income. And basically that is it. That's what was required in that part. And the marks allocated here were 4 marks. So the items now which were marked, or the items which were marked are those 4 items. Opening balance, this deferred tax expense on revaluation gain, the amount of deferred tax expense to be taken to the income statement, and this figure. So a candidate in that case was supposed to get to how many marks? 4 marks. So basically that is it. That what was required as far as that illustration is concerned. So once we come back in our next session, still I want us to look on another illustration from the same topic.